This video is for entertainment purposes only and is not financial advice. Did you know your 2025 state pension might come with an unexpected twist? The HMRC has announced new tax rules for pension income next year, and it could mean less cash in your pocket than you expected. Wondering how much you'll actually get after tax cuts and what this change could mean for your monthly budget? Stick around to understand the details and, more importantly, how you can plan for these changes. If you're interested in staying ahead of these updates and making informed choices for your finances, hit that subscribe button now so you don't miss our latest videos on financial changes that could impact you. The recent announcement from HMRC about the tax adjustments on state pensions has left many pensioners questioning what this means for their income. For years, state pensions have been a steady and relatively predictable source of income, but with new tax rates set to take effect, things are about to change. Many people aren't aware of how this change could impact them directly, and the potential for a surprise tax bill could come as a shock. To add to the confusion, the process for calculating pension tax can be complicated, leaving some feeling uncertain about what their financial future holds. Let's break down what this means and why it's crucial to know exactly how much will end up in your bank account. For those not familiar with how pension taxation works, here's a quick overview. In the UK, pension income can be subject to tax depending on your overall income for the year. The state pension itself is counted as taxable income, although for many people it's covered by the personal allowance threshold. However, if you receive other sources of income like private pensions, dividends, or savings interest, your state pension could push you into a higher tax bracket, resulting in more tax due. With these new rules in place for 2025, that scenario could impact even more pensioners than before. So what exactly are these changes and how might they impact your bottom line? In essence, HMRC has stated that the tax rate adjustments are aimed at aligning pension income with other income sources for tax purposes. This could mean a shift in how much is withheld from state pension payments throughout the year. Essentially, the government's goal is to ensure that all taxable incomes, including state pensions, contribute fairly under the tax system. While this may seem fair in principle, it could result in a reduced monthly pension income for many. If you're not prepared for this adjustment, you might find that you receive less in your account than you were expecting. Now's the perfect time to think about your financial plans for 2025 and decide how these changes could influence them. If you haven't already, subscribe to our channel to stay informed about updates and ways to make the most of your pension income in light of these changes. So let's dive into the specifics. In 2025, the personal tax allowance is expected to remain at its current level, which means that the amount of income you can earn tax-free each year stays the same. However, as inflation affects both earnings and living costs, the fixed personal allowance threshold might cause more pensioners to exceed it, especially if they have additional income sources. This change in tax policy could lead to higher effective tax rates for those who cross that threshold. It's a subtle change, but its impact could be significant, as it brings more people into higher tax bands without an increase in the allowance itself. Do you think these changes are fair, or do they feel like an extra tax burden on retirees? Let us know in the comments below. The HMRC has also announced that they'll be applying these tax changes automatically, meaning that pensioners don't have to worry about manually adjusting their payments. However, this could still mean an unexpected drop in monthly income once the new rules kick in. To avoid any surprises, you might want to check your expected tax band and calculate how this adjustment will impact your actual pension income. This step can make a huge difference in your budget planning and help you avoid falling short of cash each month. If you're in a situation where your state pension is your primary source of income, these tax adjustments could be especially concerning. Even though the changes aim to standardize tax treatment, they could disproportionately affect those who rely heavily on their pension payments to cover living expenses. Now more than ever, it's a good time to review any other income streams you may have and consider how they might interact with your pension income under this new tax scheme. And if you're finding this information helpful, please consider subscribing to our channel for more content like this. Let's talk numbers. Say your state pension provides you with an income close to the personal allowance. If you're receiving income from other sources like rental income, an annuity, or investments, it's very likely that this extra income will push you into a taxable bracket. This means that even a small amount of extra income can bring about a noticeable tax hit on your pension. For those on the cusp of these thresholds, this tax adjustment could make a bigger difference than you might expect. Are you someone with multiple income sources? Drop a comment below to share your thoughts on how this tax adjustment might affect you. One of the key strategies to cope with this shift is to look into tax-efficient investments or savings accounts. Options like ISA's individual savings accounts could provide a way to supplement your pension without adding to your taxable income. With ISAs, the income you generate remains tax-free, which could help you keep more of your state pension intact under the new rules. Also, if you're considering taking out any lump sums from private pensions, it might be worth doing so before 2025 to avoid increased tax charges. For those wanting more in-depth guidance on how to maximize their income, be sure to hit that notification bell so you won't miss our upcoming videos on managing your pension and savings. Another point to consider is tax relief for married couples or those in civil partnerships. The marriage allowance allows a spouse or civil partner to transfer a portion of their unused personal allowance to the other partner. If you and your spouse are both receiving state pensions and one of you has unused allowances, transferring them could be a way to reduce your overall tax burden. It's a smart move for couples wanting to optimize their income and avoid paying unnecessary taxes on their pensions. Every little helps, and with these tax changes, it's worth looking into every possible angle to keep more of your hard-earned pension. When all is said and done, the reality is that this HMRC adjustment is part of a broader initiative to create a more balanced tax system. But for many retirees, it might feel like an added burden, especially in a time when living costs are already rising. By taking a proactive approach and reviewing your finances now, you can be better prepared when these new tax rules come into effect. And if you're interested in more tips on navigating financial changes as a pensioner, don't forget to subscribe and stay connected for our latest insights. Let's sum it up. In 2025, state pensions will face tax adjustments that could reduce the amount you take home each month. The good news is that by understanding your income sources and tax brackets, you can make informed decisions and potentially minimize the impact on your overall income. Whether it's exploring tax-efficient savings options, utilizing spousal allowances, or simply staying informed, there are ways to adapt to these changes without feeling the full brunt of the tax increase. As we wrap up, remember that staying informed about your pension and tax changes can have a big impact on your quality of life in retirement. Share this video with anyone you know who might benefit from understanding these upcoming changes, and join us for more practical tips to help you navigate your finances effectively. Before you go, make sure you're subscribed so you don't miss any of our future updates. Thanks for watching, and we'll see you in the next video.